question is a good one. As it relates to Twitter, it feels like in this particular issue, as it relates to Saudi Arabia, they're taking all of the right steps. That being said, I think it does underscore one of the key issues that we address in our downgrade, which is maintaining a platform of this scale is extraordinarily expensive, and there's always going to be bad actors looking to exploit loopholes. So from that standpoint, the level of investment necessary to sustain the kind of growth that investors are demanding, we think that analysts at this point haven't necessarily appreciated that to the full extent that that might be the case.
All right, so it sounds like you think maybe Twitter might have to spend more on security, and this might include physical security along with cybersecurity. You're also making the point in your downgrade note to accelerating that Twitter has basically been starving itself in order to boost its margins. I mean, it sounds like they haven't really invested nearly as much as competitors like Snap have.
That's right. So that's really the key point that we try to make in our downgrade, which is if we look at the 3Q result, the key takeaway is that Twitter has benefited from a sustained period of underinvestment. And if we look at relative R&D expenses across Twitter, Snapchat, Pinterest, Facebook, Google, the key takeaway there is that Twitter's clearly lagged. And we think in a market where you do have persistent cost inflation, the need to continually reinvest, Twitter has really missed the mark there. And for that reason, we think the company's reached peak margins, and going forward, we're going to be in a period of a lower margin business than a lot of investors expect.
So what's the medicine that the company needs to take? Will they take it, and how long will it take to take effect?
That's a good question. And ultimately, what we believe is the company could undergo a period of sustained, accelerated investment. However, the challenge for the company is that investors haven't really internalized that dynamic yet. If we look out for street, free cash flow estimates, we think they're about 20% too high by the time you get out to 2022. So again, ultimately what will happen in our view is estimates will need to come down, and in an environment where estimates are coming down, the stock will have a hard time moving higher.
If they keep hitting DAU targets, though, Kevin, does this matter, or does this issue fade? I mean, if they're able to do it without spending that much, more power to them, right?
Well, if we want to talk just about DAUs, they can certainly sustain the growth we're seeing now. However, and I think this is a key takeaway, not just from the 3Q, but some of the underperformance we've seen from other high revenue growth names, is that profitability matters as well. And that's really where you're going to run into the challenges. Revenue can sustain itself, but doing so is going to require a level of investment that, again, we don't think people have really come to grips with yet.